Okay. So this was the quiz, right? First quiz. Second, S means second set. Yeah. After S means second set after the first midterm exam. So QS1, second set, first one. So in the forecasted financial statement method, which the following is not, what's going on? What's going on? What did I do? Why this one? This means. Stop share. Okay, so now it's okay, right? Still, still, any tech savvy student? Why this one is not working? Suddenly. Why this one? It's not working. Why there is no color here? What did I do? Which means. So I'll just, I don't have to really write. So in the forecasted financial statement FFS method, which of the following items is not forecasted by the percent of sales method? Cash, definitely cash is percentage of sales. Account payable, same thing, right? All those are spontaneous items. Inventory and cost of goods sold. That also is forecast by percentage of sales, right? So, but that is definitely not operation, right? We emphasized it many times. But can you believe this? There are 8 people who missed this one. So actually, last class, I emphasized many times, but so that this quiz was actually related to last Tuesday's lecture too, but people missed. The answer is that, okay? Then let's continue our lecture. So this was the last slide. So if the fixed asset is not utilized 100%, then you have to calculate capacity sales and you have to calculate full capacity, fixed asset capital intensity ratio or full capacity ratio. And then what? Then you multiply that to next year's sales, right? Next year's sales times full capacity ratio. Then what? Then that will be next year's net fixed asset. The remainder is the same. So next item. Economies of scale. So that is before this line, oh, now it's working. So this line starts from 0. So that means the ratio always stays the same, right? Because it starts from 0. But you have some, let's say, base stock, this much different color. So this much is base stock, right? Then, for you to just generate 2,000 shares, you need $1,000, so 2-to-1 ratio, right? $1,000 asset. But from 2,000 to 2,500, you need only what? $100 more, right? Before it was 0.5, now it is actually delta S is 500 and delta asset is only 100. So now this is only 0.2. Before is what? 1,000 over 2,000, right? 0.5. But now 500 more, you have what? Only $100 more, right? So that's additionally, but total is 100 over 2,000, 1,100 over 2,500. That is what? Using our technology. $1,100 over 2,500, 0.44. So it is just different. So different asset ratio according to sales. So here it shows 0.5, 1,000 over 2,000, 0.5, 1,100 over 2,005 is 0.44. So declining ratio shows economies of scale. So you are getting big, then you have some kind of economy, right? So going from 0 to 2,000 requires thousands of assets. Next 500 sales requires only 100 of assets. That this one, right? Only for that area, only 0.2. So that is economies of scale. So the bigger operation have some benefit, right? So that makes sense. Yeah, for you to produce smaller amount, yeah, it may cost relatively high, but from bigger amount, it's easy to generate just more sales using small number of assets, economies of scale. So bigger company has advantage over smaller companies. So this one is definitely exception of right, the additional fund. So this is exception to additional fund needed formula, right? because additional fund needed formula assumes what? Constant capital intensity ratio, right? But this one just ratio changes. Another exception, this is also exception. Exception 2, AFN formula. This one, and this actually corresponds to real life more. Why? Generally, they have some excess capacity for using current asset, right? And when they just 100% utilization case like this, then they just like build a factory, let's say, then they increase their asset, then what? Bigger factory, they may operate first 50%, 60%, and then finally 100%, then what? Then they build another factory, something like that. So it is, we call it lumpy asset. So this capital intensity ratio, asset over sales, changes if assets are lumpy like this. This is like a more general case. So generally they will have excess capacity, right? Until here, then at this point, 100%, then they have to increase their sales, they have to build a new factory, right? So fixed asset, they cannot increase proportional to sales, right? They cannot increase asset one-to-one to sales. That's definitely not. So small increase in sales leads to large increase in asset, and then lumpy. Then that just to maintain that facility until it hits 100%, then what? Lumpy, something like that. So that is lumpy asset, still exception to AFN formula. Then this one just requires understanding. Okay, you have to understand rather than try to memorize things. Just try to understand. Then what? You don't have to really memorize. So how different factors affect AFN forecast? So it's easily to be on the quiz or exam, right? Excess capacity, then what? Then that lowers AFN. Why? Because, less need for fixed asset increase, right? For you to increase fixed asset, you need more cash outside, right? But you have excess capacity, then you don't need it. So that lowers additional fund needed, right? Needed. And economies of scale leads to less than proportional asset increase, right? Okay, as we see here, less than proportional, right? And then lumpy assets leads to large periodic AFN requirements, recurring excess capacity. So excess capacity is, in some sense, a norm because they just use current fixed asset to generate sales. But if they need more, then what? They usually build big factory, right, for the future. Then they have excess capacity again. So those ones, again, just if you think, then totally makes sense. Then finally, this is really a good question. This is a really good question for you to practice or summarize or wrap up almost everything we learned from chapter 9. So this is a really good question, and it includes almost everything for just forecasting financial statement method.
Professor, would you mind opening like a complete blank PowerPoint where this question is on the side and you're performing the entire question on that particular page? Would that be asking for too much?
Oh, one more time.
Could you minimize this as a question on the corner right and a corner left, and then just try to perform the entire question on one page, like from top to down, so we're like following in its entirety?
Actually, we have this one. Everything is here.
Sounds good.
Yeah, good suggestion. It's already here.
Sure, okay. I didn't know that.
Big participation, that's good. So before we get to here, first we have to understand what the question means. It's long, but actually it's not that difficult. So let's you have been given the attached information, that is this one, attached information. And then what? Crum expects sales to grow by 50%. So from here, we know that G is 50% in the next year, and operating cost should increase in proportion to sales. Actually, you don't need this, right? Spontaneous just increase proportion. Fixed assets were being operated at 40% of capacity. So we know that this is not 100%. And if this is on the exam or quiz, this is so something I may make sure that some numbers can change this. So this can change, right? 40% of capacity, but maybe I'll change it to 100% or 80%. Then what? Then the answer will be different. And then, but other assets were used to full capacity. That means other assets will increase, same as the sales increase. Underutilized fixed assets cannot be sold. So that is just, like extra one. Actually, you don't need this, right? Current assets and spontaneous liabilities should increase in proportion to sales. Again, this one is also, you don't need that. So maybe in the exam, maybe I'll make it short, because those ones are basically what? Assumptions. So we already said that. And the company plans to finance any external funds needed. This is important information, right? As 35% notes payable and 65% common stock. I can change this one like 35% notes payable and 65% long-term debt or whatever, right? So those ones also can be changed. And the interest rate is 8%. Base interest expense on the debt at the beginning of the year. And this one also you don't need. We can make it short. Those ones are what we have assumed so far, right? The dividend payout ratio will remain constant irrespective of how many shares of stock are outstanding. So this one is also can be just erased. What is Crum's projected ROE using the percentage of sales method? So the question is, the answer is to calculate projected ROE, but to calculate that, we need to use forecasted financial statement method. So all you have to do is just actually multiply by 1.5, because what? 50% increase, right? And it says the percentage of sales method, but we assume that everything is increased in proportion to sales. So it boils down to just growing every items, spontaneous items, by multiplying by 1.5. So this is next year's forecast is 1,500, and 1.5 plus 800 is 1,200. Then 1,200 minus 1,500 minus 1,200 is 300. So far, so good. But how would you calculate interest given this data? So all the data are given. So how would you calculate interest given this data? Anybody?
1 minus the payout ratio.
Oh no, that is retention. This is I'm asking interest. Again, wrong answer is better than
8%. Interest is 8%, correct?
Check. Good point. Yeah. Then what?
So 8% of 300 would be 24.
8% of 2,700.
300? Where did 300 come from?
Okay, so 8% of 2,700.
2,700?
So
Where
it's
did you get
Oh, I'm sorry. So 1,300. Sorry about that.
1,300?
Yeah.
Where did 1,300 come from?
So I got like sale is like 1,500 minus 1,200 is 300 times 8% is.
No, 300 is EBIT. Don't forget that interest is what? First formula from time value from 3 or 4 time value money is that interest equals principal times interest rate, interest rate. So that is the first formula, but very important. See, you can still apply that. Interest calculation is principal times interest rate. So that's my hint. Then what? Then let me ask you, what is the principal here?
$1,000?
1,000 is sales. You don't forget sales. You didn't borrow money. Sales is you sold it, not borrowing. Principal is how much you borrow, right? Principal.
Is interest $16?
Huh?
$16 for interest?
Check. What did you do?
8% of notes payable.
Check. Bingo. Notes payable is 200, and there is no long-term debt, so you don't have to add the long-term debt. That is only notes payable, right? So that's very important. Okay. Maybe in the exam or quiz, there may be long-term debt. Then what? Then you have to add the short-term debt, notes payable plus long-term debt times interest rate. But here, only notes payable, so that is notes payable times I. That is 200 times 0.08, 16. So that I have to use probably a different color, purple. So that is minus 16, pretty much the same. So maybe green minus 16, very important because historically many people miss this part. Then you have 284 EBT. That is taxable income as a 40% of that. 284 times 40%, 113.6 minus tax 113.6. Then you have 170.4. 170.4. 170.4. Then that is net income, right? That is net income. So that is net income. Then dividend is 60%. So multiply that by 0.6. Then you have 102.24. So in the exam, you have to show me dollars and cents. So 102.24. Then you have 68.16. That is addition to, so that is this addition to RE. Addition to RE, 68.16. Then now we have to think about, so actually this one is like this. This one is such that was maybe this one. Until here is what? Income statement. And this one is balance sheet, right? So we, because of maybe space, it should be left and right, but it's stacked like this. But this part is income statement, and this part is balance sheet. Then what? Then also this, until here is actually left-hand side. After that is right-hand side. So let's continue. Current assets. Current asset is growing spontaneously or simultaneously with sales 50%. So you multiply 700 times 1.5. 700 times 1.5 is 1050. Okay, that is this one, 1050, right? Now it's something you have to pay attention. That is what? Net fixed assets. According to this problem, how would you calculate net fixed asset?
Take the sales and divide it by the capacity.
Great. So let's see, the sales last year is 1,000. So here, capacity sales, that's a really good answer. So you are reviewing steadily, that's good. 1,000 divided by 40% of capacity is a 0.4. Then you have 2,500. That's the capacity sales. And you compare that with S1. S1 is, you already calculated here, right? S1 is 1,500 next year's forecast, 1,000 times 1.5. So S1 is 1,500, and that is less than capacity sales. So what should be next year's net fixed asset?
Should be 300.
Check, good answer. Because you don't need any fixed asset, because what? Your new sales is less than your capacity. So you don't need any, so this is some sense easy one, because you just use current net fixed asset to generate new sales. So 300 is the same, very important. Then you have 1350. So this is new total assets, left-hand side. Then you maybe we have no space, so maybe we'll move this one here. And rather than that, we have just right-hand side of balance sheet. So here we have AP and accruals. What do you want to do? AP and accruals.
AP and accruals are multiplied by 1.5.
Check. 150 times 1.5, that will be 225. And maybe this is not a good place. All this right here, AP and accruals is 150 times 1.5 is 225. And how about NP?
Stays the same.
Check. This is a financial. Just it doesn't go up with your sales. Different decision. So 200. And how about common stock?
Stays the same.
Check. This is also financial decision, 150. Same. How about retained earnings?
Adjusted by adding S1, profit margin, and the rotation ratio.
That is correct if you are using AFN, but this one, what's the answer? This one is using forecasted financial statement method. So what?
6816.
Check. Great answer. You already calculate that here. 6816. Addition to retained earnings, right? So 500 plus 6816. This is also many people miss this one, so I have to make sure, right? Then 56816, right? And then if you add this one, right-hand side, total liabilities and equity, then you add 225, 200, 150, 568.16. Then right-hand side will be 114616, 1143. So from here, we know that right-hand side is less than left-hand side. So AFN equals 1350, left-hand side, this one, minus 1143.6. That is 206.84. So that is how to calculate AFN. Now it's time to calculate how to finance this one, and that is in the problem.
Professor, can you like hit the Zoom?
Oh, okay. Again, you have to just to raise your volume. Yeah.
Okay, Professor, can you zoom in the PowerPoint slide because the word is too small for me to catch up.
Too small. Let's check. Oh, it's getting bigger. Better.
Can you make the
Like full screen?
screen bigger, like use full screen mode?
Oh, this one?
That little square at the top. I don't really know. Yeah, up more. Right there, yeah. I think you're on it. Like expand it.
But then he can't access his pens.
Oh, if it's on full screen mode, he can't access pens?
Yeah, you can't edit it.
Let's check. Let's move this one.
I don't think. Oh, I know what you're talking about. Yeah, that right there.
So it can get bigger and we can still see everything.
Good.
Thank you.
Good.
Sorry, I thought you were talking about presentation mode.
Oh, no, just this.
Good participation point. By the way, so now that is this, right? So you subtract, so AFN is this. Then how to finance, that is what? 35% notes payable and 65% common stock. So you have to, from here, the 206.84 times 35, that is 72.394. And that is for notes payable. And common stock, 206.84 times 0.65, then you will have 134.446, right? So it's like this. So you so next year after AFN, so all you have to do is now the left-hand side, the asset side is same, right? But right-hand side, the notes payable plus what? Plus 72.394. And common stock, you add 134.446. Then what? Then now your just right-hand side is, if I write down new numbers, then 225, right? And this one, 272.394. And this one, 284, 150 plus 134 is 284.446. And this one is what? 568.16. If you add them up, that should be same as left-hand side, 1350, right? So actually you finished everything, but that's not the answer yet. The answer is what would be Crumb's projected ROE, right? So final answer is ROE is what? What is ROE?
Return on equity.
Anybody?
Return on equity.
Yeah, but the number. What is the number? You are correct. But what is the number? To save time, what over what? Number wise, what over what? Anybody? So you said that net income over
Equity.
equity. So what is number? What over what? So you should be able to pick up the number.
170.4
Okay.
divided by
Good start. Try to finish.
1350.
No, 1350 is total liabilities and equity.
568.16.
That's it? No more?
852.61.
I think that's correct.
yes.
So that is net income over, you said retained only, but equity is common stock plus retained earning, right? Don't forget this. This is a common mistake. You have to add common stock and retained earnings. So net income is 170.4, and common stock is new one, not this is old one, right? So new one is 284.446 plus 568.16. The answer is 19.99%. And that's the final answer, okay? So that is actually extra question. The question actually should end here, right? But that is extra question. That's why all the chapters are interrelated. Okay? That is actually from chapter 7. But ROE is net income over equity. So equity is common stock plus retained earnings. So that is good problem, but as I said, in the exam, it can be like this. That is what? Like fixed asset were being operated at, so this one, let's say using green. This is instead of 40%, green. Instead of 40%, if 80%, let's say, if I change it to 80% of capacity, then what? Then you have to use, then what? Then capacity sales equals 1,000 over 0.8. Then what? 1250, I guess. So, but that is less than S1 is 1500, right? So in this case, you have to calculate full capacity ratio. That is, your fixed asset is what? 300, right? So 300 over capacity sales 1250, right? So you calculate that. So new fixed asset equals S1 time, that is S1 times full capacity ratio. S1 is 1500 times 300 over 1250. So 1500 times 300 divided by 1250, and 360. Then what? Then you have to put 360 here instead of 300. You have to enter 360 if it is 80%. Then you have to change all the numbers accordingly, right? For example, then total asset will be 1410 instead of 1350, right? And then you have to change the number accordingly. And one more case can be if I make it so different color, let's say. Different color will be rather than, let's say, just slightly some, I don't know the name of this one, so some blue one. Then how about 100%? Sky blue, 100%, right? Then what? Then simply, then you don't have to calculate capacity sales. If it is 100%, then all you have to do is net fixed asset times 1.5, 1 plus G, right? Because if it is 100%, then all the asset grows proportionally as sales. So 50% increase. Then what? Then you're 450, right? So then what? Then instead of 360, you write 450 and change all the other numbers accordingly, right? Income statement doesn't change, but balance sheet, total asset changes, then what? I mean, net fixed asset changes, then what? Total asset will change, and then AFN will change, but that's easy. That adjusting after that is easy. So if this is on the quiz or exam, the only change is just material changes being operated at 40% or 80% or 100%, right? According to that, net fixed asset changes and all the other numbers just should change accordingly.
Professor?
Yeah.
So like for the 80% capacity, when we calculated net fixed asset, why did we choose 300 divided by 1250? Can you explain that again, please?
That is actually, believe it or not, from this one. Excess capacity 2. Then what? Your capacity sales is 117.65, right? But there is less than 150, then we calculate full capacity fixed asset capital intensity ratio. So we just, to make it short, full capacity ratio. So 75 current fixed asset over capacity sales, right? That's what we did. Yeah. So if we go back to here, current fixed asset is 300. So 300 over capacity sales.
Okay. Thank you.
No, thanks for asking. Yeah, that is a good clarification question. Yeah. Helping your friend.
And you said, Professor, the sales would stay the same 50% increase, or would they be like 40 or maybe 80%?
Daniel, yeah, 50% increase is given. Yeah, it doesn't depends on the 80% utilization or 100%. Yeah, 50% is given. Yeah, the company's sales grow by 50%. Yeah, that's given number. That's why S1 is 1,500 no matter what, a 50% increase of 1,500. So, you compare capacity sales with what? 1,500, S1. S1 doesn't change, right? So if it is G's 50% doesn't change. So S1 is 1,500 always. So you compare capacity sales with S1. And when it is 40%, 2,500 is greater than 1,500. When it is 80%, 1,250 is less than 1,500. So you need this FCR, right? And this is the easiest one. 100%, then all you have to do is just multiply by 1 plus G. Everything grows proportionally to sales. Any other question? This is very important. This one is very highly likely to be on the exam or quiz.
Can you just go to the last slide?
Oh, sure. Like this.
Yeah, can you zoom it out just a bit so I can see the whole slide? The bottom right. Yeah.
Okay.
Thank you so much.
Welcome. Yeah, just.
So, Professor, I have where do you find the 72.394 at the note table? I'm still getting it, trying to find out
Oh, that is from the problem. It says that, any external fund, that is AFN, is financed by 35% notes payable and 65% common stock. So AFN times 0.35, and that is notes payable. AFN times 0.65, that's common stock. So that is this. That is, AFN 206. This is AFN, right? Times 35%, 72,394 is notes payable, according to the problem.
Got it.
AFN times 0.65, that is common stock. So you add that accordingly here. Yep.
Professor, I have a question. Where did the number 300 come from? Even though from the example excess capacity number 2, I didn't see a 300 there.
No, 300 is given, net fixed asset. Net fixed asset is 300, right? This is given in the problem. Net fixed asset is 300. Yeah, 300. So here, you multiply 300 by 1.5 because it grows at the same rate as sales growth. So 300 times 1.5, 450. Yep. The more you ask, the more you understand. So question is good, not only for you, but also for your friends. If somebody shy to ask, you don't have to shy to ask, just ask questions.
Can you go back to the last slide and can you tell me or remind me what the 450 is in parentheses? underneath 360.
450 is, you see, look at this color. This color means this one. 450 is when the company is operating at 100% full capacity.
Got
and
it.
So this is full capacity.
And 360 is
Fixed asset. 360 is 80%.
capacity.
Where is it? First, let me finish this one. See?
Sorry.
Full capacity. No. Fixed asset. Fixed asset. And then 360. This one, 360 is in green, right? Green means I use 80%. So 80%.
Okay, instead of 40.
Exactly, 80%, then, you get the capacity sales and then full capacity ratio.
Okay.
Yeah, and then 360, yep.
So Professor, what I don't get it is it is the interest, like the 16. So you use the 200 of the last year to calculate the interest for the next year, or why don't you use the 8% times the new note payable, like the 272.394? Why don't you use that, but instead of using 200?
Oh, that is 72.394 is how to finance AFN, right? But this interest is before that. That's why it is first pass. So that is given your current, this is current debt, right? This is current debt, right? And 72.394 is new debt. Yeah, that's why.
Professor, I have a question. For this particular question, why did we use the principal, the notes payable, to find the interest?
Oh, that is just, this is not for this one. This is general statement.
Oh.
Interest is principal times interest. But for this particular question, principal is only notes payable because there is no long-term debt. So you just use notes payable times I.
So in case we had a long term, how would it be?
Then you add notes payable and long-term debt, and the total is principal. Yeah. So
Okay.
total times interest rate. Yep.
Okay, thank you.
Yep.
Can you
See,
go
the more you ask, the more you understand. Yeah.
show the problem slide, please?
Oh, sure. Yep.
Thank you.
Yep. The 8% is given here. 8%.
Mm-hmm. Thank you.
You're welcome. Any other question? So that's the end of chapter 9. That means what? Your chapter 9 homework due next Thursday.
Wait, I do have a question. Can you go to the last slide really quick?
Sure. Yep.
Okay, I was taking notes when you were explaining this, so I didn't see. When you use the two examples, when we're using 80% capacity and 100% capacity, and you put them as the new net fixed assets, it would only affect the total assets of the equation, but would it affect any other part of what we're doing, like the math, or just that one part?
No, it affects total asset, then what?
Oh,
then,
yeah, and what we are multiplying at, I remember,
then that will affect AFN because, total asset minus SI, right? Then that will affect notes payable because that AFN times. So all those numbers will change. But that's easy, right? You can just, all you have to do is only this one changes, right? But this one changes and this one stay the same, right?
I don't know
But-
what's this. Do you have like a pointer? I don't really know where you're saying this and this right now.
Oh, sorry.
Okay.
So
Okay, there we go.
T is only the number that changed, right?
Yeah.
And
And
this
so
one
it's
stay the same. This one stay the same, right?
Mhm.
But since this number changes, so this number should change too, right?
Okay, and then the equations below that.
And this one also changes, so these numbers all changes. Then what?
Okay.
Then those numbers. So you can change everything accordingly. So no problem. Yeah.
Okay, thank you. I understand.
Good. See, question really helps.
Okay, I have another question.
Sure.
When you did the next year liabilities and equity side of the balance sheet, you did notes payable 200 plus 72.394. Where did you get that?
That is this. Not this one. So clear this one. 72,394 goes to here.
Oh, got it.
That
Got
is-
it.
Go first. And 134,446 goes to here because
Got
that
it.
is from, yeah. Oh, good. So you guys are now getting almost 100% now, right?
Professor,
Oh, okay.
can you please again explain where this 1250 came from for the net fixed asset? I'm sorry.
1250?
1250, yes, for net fixed asset for the 80% capacity. Like we did
That is,
300 divided by 1250. I don't understand where this 1250 came from.
that is this one. Let me show you. Capacity sales. 80%, so 1,000 sales over the.
Oh, okay.
Yeah.
I see.
Okay. Yeah.
Thank
okay.
you.
Welcome. Yeah. So just ask questions. Yeah, everything really makes sense. And this is very important. So it's worth spending time to understand 100%. But understanding is not enough, as I said. You have to practice. If you do it yourself without looking at the answer, so as I said, it's better for you to do it without looking at the answer and try to solve it yourself. Then maybe sometimes you get stuck. Then what? Then you practice again. But don't just look at the answer and, oh, that makes sense. That's not enough. Definitely not enough.
Professor, I have a general question.
Oh, sure.
So there are two ways to find AFN. It's the equation way and the pro forma. On the quizzes and exams, are we only going to be doing the pro forma way rather than the equation way, or are we going to be doing both?
Oh, both, because
And it'll be specified in the question.
Yeah. So you'll know in the exam, based on AFN formula, what is this, and based on FFS formula, what is the FFS method. So you have to know both. Don't forget that in this class you have to know everything, right? So yeah, don't expect that only AFN formula will be on the exam or quiz, or only FFS. No, both can be on the exam. Yep. Okay, so that's the end of chapter 9, and now we are on chapter 10, right? Somebody have some question?
Yeah. Last question, Professor.
Oh, no problem.
Yeah, I'm kind of looking for like what number, like the number is like 1143.6 in the additional fund. Like, how do you find it? I'm trying to figure it out. Yeah.
AFN?
Yeah, so 1143.6. Like, where do you get it? Yeah.
1143.6 is this, right-hand side, total liability and equity.
So when I sum it, like I sum it, it's come out to be 1350 though.
You can add them. 225. Where is the calculator? Let's see. Calculator.
Slide up your chapter 10 window. Just drag it up.
Yeah, good participation point. So, thank you. But this one, so I cannot get to the part. So I add this one. So let's add 225 plus 272.394 plus 284.446 plus 568.16 1350. Oh, sorry, that is a due one.
Yeah,
so
yeah.
So I have to go back.
That's why I was wondering.
Yeah, you have to add. That is after second pass. So you have to add 225, right? 225 plus 200. 200 is notes payable plus common stock 150 plus retained earnings 568.16 1143.16, right? So by the way, so 1143.16 is before, so this one, this part, this one, 225 plus 200 plus 100 plus this. And 1350 is you add this AFN, 72.394 and 134.446. Then you get 1350, right? So 1143.16 is first pass. And second pass is when you use external financing, these two, right? So this two is from AFN, right? So 1143.16 is before AFN, so that you subtract that from 1350, right? So if you add AFN, then you get 1350, same as total rest. Yep. Okay. So let's go back to, let's go back to chapter 10. So chapter 10 is determining the cost of capital. Actually, we did that in 304, so we can go a little bit faster, but we'll talk more and more in depth. Now, that's why 404. So cost of capital components, debt, preferred stock, common equity. And then WACC, we did it in 304, but we didn't do divisional cost of capital and also marginal cost of capital. Those things are brand new one. So let's just do it one by one. So what types of long-term capital do companies use? Oh, by the way, today's quiz will start from 419, so only 9 minutes. So long-term debt, preferred stock, and common equity, those ones. Then capital components are sources of funding that come from investors. Accounts payable, accruals, and deferred taxes are not sources of funding that come from investors. So they are not included in the calculation of cost of capital. Why? Those ones, there is no interest. So that's why we said the account payable is like free financing. okay? It's not debt. If it is a debt, then what? You have to pay interest. There's some kind of no cost or free financing. So they are not, so there is no cost, so there's not included cost of capital. And then next, before tax versus after tax capital cost. That is what? You have to think about always after tax, right? So because you cannot ignore tax. Tax effects associated with financing can be incorporated either in capital budgeting, cash flows, or in cost of capital. So if your cash flows are after tax, then cost of capital should be after tax, all right, to be consistent. And most firms incorporate tax effects in the cost of capital. So we have to focus on after-tax costs, but only cost of debt is affected. Why? Only interest is tax deductible. Dividend is what paid from after-tax income. So only cost of debt is affected. And this one is important. Historical cost or new marginal cost. The cost of capital is used primarily to make decisions which involve raising and investing new capital. So we should focus on marginal cost. That means the reason we calculate cost of capital is to evaluate what? New project, right? Not just old project. So cost of capital has to be new or marginal cost. That's extremely important. Okay, don't forget that. We'll talk about that later. Then first is cost of debt. Now, how to calculate cost of debt? First method is ask an investment banker. So what should be the coupon rate when you issue new bond? So new debt. Second way is find the bond rating for the company and use the yield on other bonds with a similar rating. So second way is you try to see a company that engage in a similar line of business, similar risk, and those ones, and use their bond rating as yours. But that is too just general, too vague. But method 3 is more accurate because find the yield on the company's debt. That is what? Your company's debt, if it has any. So if you have some debt, then you will find the cost of debt from your debt. How? So like this. A 15-year, 12% semi-annual bonds sells for 1153.72. What is RLD? RLD stands for actually return on, D stands for debt, right? But that is also cost of debt. Why? Because return on debt means what? Return on debt to investors, right? Investors return. Then what? For you to get money from investors, in other words, for you to borrow money from investors, you have to give them the return they require. So what? Suddenly, investors' return becomes what? Your cost. So that's why RLD is sometimes used as return on debt, or sometimes used cost of debt. And this chapter 10, is cost of capital. So in cost of capital chapter, RLD stands for cost of debt. That's why RD, return on debt, is actually cost of capital. In other words, you are now at the other side of the table. Before, when you talk about return, you are investor side. But now you are on corporate treasurer's side or financial manager side. Then what? For you to get money from investors, you have to give them the return they require. Then what? That becomes your cost. So that's what RD means. Then the given this problem, actually, this is your company's bond. And you are paying 12% semi-annual coupon. So my question is 12% RD? %50 chance of correct. Right or wrong?
No.
No. Correct. Why? Why is important? The answer is this. You are calculating due or marginal cost, not historical. So this 12% is actually historical cost. That is, this is now 15-year bond, but maybe originally when they first issued this bond, it may have been 30-year bond. That means what? 15 years have passed. So 12% is actually interest rate 15 years ago, right? So it's historical loan, not new one. So that cannot be RD. RD is due one. Then how would you calculate due one, RD? That's the topic. That's the topic. But unfortunately, time's up. Time's up. So we'll talk about that next class. But everything we talked about today can be on the exam, right? No, can be on the quiz, next quiz. So let's just stop share. And oh, that's a good question. Yeah, so you should ask questions in class, but too late. I'll answer that question next class. So